Today I'd like to talk a little bit about the fiduciary versus the broker. This is not quite of the magnitude or the importance of David versus Goliath, but when you consider why it matters to your finances, it kind of ranks up there. So let's delve into that. This whole conversation of fiduciary versus the broker really translates into the fiduciary standard versus the suitability standard. See, the fiduciary standard, kind of the gold standard of financial advice, it requires the advisor to act solely in the client's best interest, to put the client's interests ahead of their own, to provide full and fair disclosure of all relevant information, to seek best execution, and to provide ongoing monitoring. Sounds great, right? Suitability standard is not quite as great. Matter of fact, we're going to find out as we go through today how it really falls short. But to tell you what it is in a nutshell, the suitability standard is a standard that only requires that an advisor make a recommendation that is suitable for the client's financial profile, consistent with broadly defined risk tolerance, time horizons, and objectives. If you've worked with a broker before, you probably remember that they'll go through a questionnaire, and it's usually standard and it's on a piece of paper, and out of that they come, oh, you look like you're going to be moderate or moderate growth or aggressive growth. They have these broad terms. They don't really mean anything specific, but they are these broad terms. Those are generated by his or her understanding of your time horizon, your objectives, your risk tolerance. They're good, but they don't go far enough because they're not detailed enough. In practice, what this then means is that an investment, or really any recommendation, would be appropriate, as the letter of the law would state, if it could be recommended, even if a cheaper equivalent exists somewhere else, or a commission's higher than something else that they could recommend, or there's a better long-term alternative, or that there's a conflict of interest tainting the actual recommendation. In other words, suitability means that this advisor, this broker, does not need to put your interest ahead of their own, only that the recommendation that they're making is not inappropriate. So advisor compensation impacts this directly, and there are a couple of different models that are used. The industry grown up on the commission model, and it represents the greatest conflict of interest, and as the name would imply, commissions, it is sales driven. The advisor is paid by selling financial products, mutual funds with loads, annuities, insurance policies. Weird thing is you may not actually write a check. In the bad old days, yeah, you had to write a check, but today it gets hidden. The cost is embedded in the account, but nonetheless, it's coming out of your pocket. You just don't see it, and it's going into the advisor, the product pusher's product. The standard of care is clearly not fiduciary. It is just suitability. As long as this product is suitable, not necessarily best, not necessarily lowest cost, not necessarily the one that optimizes or best aligns with your plans and your objectives, just that it is suitable. This means for you, there are strong incentives for the advisor to sell higher commission products. These costs are hidden, ongoing. They're hard for you to actually evaluate. You can't really see where they are. And the advice is going to be product-driven, not plan-driven. You'll probably notice that those intake conversations have been relatively short. They don't go on for hours. They don't go on for days. In a true planning process, you might have several meetings with an advisor to tease out in greater and greater specificity goals, constraints, your specific financial situation. Now, these are confined to relatively short periods of time to determine suitability. So a plan is not going to really come out of this. The plan's not going to drive the recommendations. Now, other end of the spectrum here is the fee-only model. It is the most objective, it is transparent, it's client-focused, it aligns with the fiduciary standard. The advisor is being paid only by you, and that can be a flat fee, it could be an hourly fee, it could be a percentage of assets that are under management, but the point is that you are aware of paying the fee, and it's going from you to them. There's no third party that's collecting something, there's no third party that's selling something. There are no commissions of any kind, and so that fiduciary standard applies, and it should apply at all times. We'll talk a little bit about that later, but it's that legal obligation to act only in your best interest. What that means for you is the advice is not driven or influenced by product sales, that the highest ethical standard in the country, fiduciary, is being used, that there's clear, transparent pricing, there is a planning first approach, and when done right, it is holistic in application. It may take hours, it may take several meetings, but it's worth developing that full plan so that you know the recommendations are in your best interest with a full understanding of what your best interest is. Now, fee only is gaining ground. Fiduciary is gaining ground because it has a lot of benefits. It is best for you, and sadly, this industry has tried to obfuscate that, tried to confuse that. They're holding on by their fingertips to the commission model. But when that doesn't work, when the client says, I don't want to do that, I'm looking for something else, they've sadly come up with something that, again, confuses and obfuscates. It's called the fee-based model. It is the most confusing. It is the most deceptive because it does rely on fees. It does sound like fee only, but it's actually a combination of a fee, sometimes ongoing out of the assets, sometimes not, sometimes paid directly, sometimes paid on an hourly basis. But what's added to it are commissions from certain products that come out of the recommendation. This allows the advisor to literally switch between being a fiduciary when charging these fees and not being a fiduciary, using only the suitability standard when pushing a product. That's why I said earlier that you need to be looking for a fiduciary. You need to have someone that is utilizing that fiduciary standard all of the time. The lobbyists in my industry, and sadly, were very successful in lobbying to get the term fiduciary changed. It used to mean all the time looking at the best interests of clients. Now it just means that as long as you're acting at a specific time in the client's best interest, you can be a fiduciary during that time. And then you can switch, so long as you tell the client somehow, wave the little red flag, I'm switching from being a fiduciary to now I'm just being a product pusher. Usually it's not a red flag, usually it's a very subtle switch and you don't know it. So what this means is there are built-in and hidden conflicts of interest. It's hard to tell when the advisor is moving from being objective to being incentivized. And I would argue that even the best people, human nature being what it is, if you're trying to act as fiduciary, if they know that at the back end of fiduciary there's a product sale, it's going to get tainted. That fiduciary standard is not going to be 100% implemented. It's just, again, it's human nature. But many people do mistake this for fee only. I can't say the number of clients or prospective clients that have come in and said, well, the reason that we want to meet with you is because we're looking for a fee-based planner, and we take them through so they understand it's getting close, but it's not fee only, it's not the full fiduciary standard. The way to really tell, you can't just rely on someone saying, oh, we don't charge any commissions. That doesn't mean fee only. That just means that they're not being a fiduciary all the time. The key question really is to ask, do you or does your firm receive any commissions at any time from anyone, or any product-based fees or any revenue sharing? Is there anything other than a fee from me to you? Only them saying it's fee only means that it's a fiduciary. I would recommend that you get this in writing, because only when you get it in writing do you know that the advisor knows they're committing a felony if they mislead you. If it's verbal, there's always the chance of the he said, she said. So ask the right question, do it in an email, do it in a letter, whatever form, but get the response in writing so you can save it. Then you're liable to know that that is the correct answer. It's the truthful answer. This may still feel a bit theoretical, so let's try to make it a little more practical. Let's look at where the suitability standard can actually fall short. And it doesn't fall short because it's necessarily wrong. It falls short because it's usually not the best solution. It falls short, for example, because cost differences matter over time. So you see, under suitability, two investments can both be appropriate. Example, you have a mutual fund that has an expense ratio of 1.2%. That means inside the fund, they're charging 1.2%. Let's say they earn 8%, they're going to peel off 1.2, so they're really going to give you 6.8. All you really know is, oh, I got 6.8. You don't know that there's a fee that was pulled off, and out of that fee, then there is a commission. There's money going back to the advisor who recommended it. Okay? Versus that same fund or the same type of fund, an index fund, let's say, that charges 0.05%. Bare minimum fees. There's no room for any commissions in this. This is just the operating cost of providing a fund for you. Both are suitable for a moderate risk investor under the suitability standard. They might not both be right under the fiduciary standard, because you'd have to have that conversation to understand, well, what am I paying an extra 1.2% for? Over 20 years, given compounding, the difference between 1.2 and 0.05 in my example is substantial. That gap compounds every single year. So suitability falls short and that it does not recommend the lower cost alternative. Now, suitability also falls short because it influences product selection. You've got the difference between the loaded mutual funds, the no loaded mutual funds, variable annuity versus low cost portfolio management, structured notes versus buffered ETFs. The list goes on and on and on. If it fits with the client's objective and risk profile, it passes the suitability test, but it still falls short. It doesn't require minimizing of compensation conflicts. Suitability also falls short when tax optimization is just not good enough. It doesn't mean it's not there. It's not wrong. It just isn't good enough. Suitability is focusing on risk tolerance and objectives, not on tax efficiency. For example, a high-income client holds taxable bonds in the taxable account when maybe munis or asset allocation strategies would materially improve after-tax returns. The allocation may be more suitable, but it's not tax optimized. It's not the best for the client in that situation. Suitability falls short when planning depth is limited. Because suitability is typically transaction-based, it's on that sale, it's on that product, the broker is going to recommend a balanced fund for retirement savings, let's say. That may be suitable even if there has been no retirement cash flow analysis. There's been no Social Security timing review. There's been no Roth conversion strategies done. There's been no estate strategy integration. It falls short, in other words, because it focuses on product appropriateness, given these broad definitions, versus holistic optimization. Suitability falls short when market condition changes. See, suitability applies only at the time of the recommendation. If markets change, if tax law changes come in, if life circumstances shift, there is not necessarily an ongoing duty to proactively revisit the whole decision, the whole product selection, unless another recommendation needs to be made or is requested to be made. There is no obligation for them to be proactive. Fiduciary relationships, though, imply an ongoing monitoring. The suitability standard also falls short because coaching is absent. You see, suitability does not require what we call downside risk framing or behavioral guidelines, volatility stress testing. These are all fancy words, which basically means we're trying to engage the emotional part of the decision as well as the intellectual part of the decision. An example here. A 70-30 portfolio, 70% in equities, 30% in bonds, is going to be suitable for moderate risk. Again, that big broad term, moderate risk. But if a client who goes through that little questionnaire with the brokers ends up being moderate risk, but ends up panicking because their portfolio is off 15% one year when the market takes a dump, that advice is going to fail in practice because you're going to pull out. You're going to pull out at the worst possible time because nobody engaged and said, really, what's it going to feel like when this market's off? When you've had $1 million, you just lost 150 grand. That's what 15% off on $1 million does. If that's not going to sit well in the heart, then you can't just rely on the head to have made the decision. Suitability also is going to fall short when liquidity or complexity is not fully examined and explained. There are lots of non-traded REITs, interval funds, structured products. They may be great. They're all going to be suitable based on net worth, income, and risk profile. They may or may not be great, but suitability doesn't demand that we go down that path and determine whether they actually work for you. There are no comparative liquidity analysis studies that are required. There's no stress case modeling that's required. The scenario testing under adverse markets, which would tell you, does this complexity hold together? Is there a sufficient liquidity for you during retirement? So given all of this, given the differences between the fiduciary standard and the suitability standard, given all the ways in which suitability is going to fall short, if you're a high net worth individual, there are a couple questions you really should ask before you engage, before you hire an advisor. You see, for you, the risk is not just poor returns. The risks are structural inefficiencies, tax drag, behavioral misalignments, these hidden conflicts of interest that compound over time. So here's the quick list of key questions to ask. Are you legally acting as a fiduciary at all times? Can you show me exactly how you get paid on my account? Are there AUM fees, easy for me to say, flat fees, retainers, commissions, alternatives, minimum fees, custodial, platform sharing, all the ways in which they could get money? You're asking, show me exactly, please, how you're going to get paid on my account. What do you believe about markets? Look for evidence-based frameworks. versus performance chasing. Look for cost discipline, tax awareness, behavioral philosophies. How do you minimize taxes? Great question, key question. For high net worth individuals, the tax success often exceeds investment success. So you want to know, is this advisor going to provide tax loss harvesting systematically? Are they going to coordinate with your CPA? Will they do Roth conversion modeling? Are they looking at taxes just year by year, or are they trying to look at this over a lifetime? You should also ask, how do you define risk so that you understand you're on the same page with how they understand risk? Is it just permanent capital loss, or is it the volatility from year to year? Those elicit different parts of the brain and different parts of the heart. What does comprehensive mean to you? Because I would argue that if someone's not going to be fiduciary all the time, but work with you for a long term and look comprehensively, you're not getting the full benefit of fiduciary standard. So ask specifically, are you going to do trust reviews, philanthropic structuring, estate planning coordination, liquidity event planning, business succession, help me with family governance and management? So many firms will say holistic, but they deliver portfolio management only. So ask the question, what does comprehensive mean to you? Another question to ask, who actually is going to work on my account? Is it you, or are you just the onboarding specialist in the firm? Is it you, or is it a junior advisor? What happens if you retire? What's the succession plan? You need to know who you're going to work with, who's going to actually be providing that fiduciary holistic advice. Finally, ask to see their ADV Part 2, the legal document, and then some samples. Ask for a redacted sample of a financial plan. Ask for a sample of investment policy statement. Get that Form ADV Part 2. Ask how they handled March 2020 or 2008 so you get a sense for, in the real world, what did they do with clients during these market downturns. Bottom line is that making the right choice matters. Competent advisors welcome this scrutiny. We would love to have the chance to answer those questions for you. I assure you we'll answer them the right way because we are holistic, fiduciary, comprehensive. We're going to help you get from where you are to wherever you want to be. So give us a call, send us an email. We'd love to chat. Thanks again for listening.